Julius, you're happy? Henry, Adrian,
Yep,
Bob,
absolutely.
Derek, everybody's happy. That's good. Okay, so we're now recording, so that's good. And so I will monitor the lobby with Chris, and oh, another joiner. Morning, Adrian. Thanks for joining. If you've just joined, actually, if you could mute, please, that'd be great. Jim, if you could mute, that'd be good. Thanks very much, Jim. Brilliant, thank you. And Rosalind. Morning, Rosalind. Thanks for joining. If you could mute, please, that would be great. That's good. Okay, brilliant. Okay. So, Henry, I don't know whether you want to lead on this one or you want me to sort of kick things off, but this is this week's session is in conversation with Julius Pursaill. We're talking about fiduciary duty and the opinion given by Eversheds, Julius. Now, I don't know whether, because it's hot off the press, you want to spend 5 or 10 minutes giving us your opinion on tariffs and the impact on British, European, and global markets. I don't know, but is there a Julius Pursaill version of what the hell is Trump doing, and why are we all licking our wounds in the last few days? Do you want to have a quick session on tariffs first before we get into the nitty gritty? Because I'm actually very interested in what you have to say about that.
Well, I think most of what I say about Trump is probably unrepeatable, and certainly not while I'm being recorded. So what can I sensibly say about tariffs? Well, actually, I think what I probably would observe is I think there is a kind of connection with the rest of the agenda today. So let me draw that out. The reason why we asked for this opinion from Eversheds or worked with them to create it was because, for reasons I will unpack later, Cushion's pretty supportive of the UK government's growth agenda. And I think there is a connection with tariffs here, because I think that international companies are far more likely to be hit much harder by a tariff war than companies with shorter supply chains that are primarily building their businesses in the UK. So I kind of think that the Trump backdrop, which is frankly, I think, very alarming, and I can see a credible path to a civil war in America. So I think it's very alarming indeed. And while we may agree that there is something wrong in the trade balance between China and the rest of the world, I think this is pretty dangerous medicine. But that aside, I think that there is good reason for being more positive about supporting domestic UK orientated companies than maybe before the tariff war started.
Yep, agreed. Henry, you were just about to say something then. I don't know if you had an
no,
opinion.
I wasn't. I was simply going to
gasping.
Agree with what Julius said.
Yeah. I mean, we've got Podreg on. Hi, Podreg. Thanks for joining. Obviously, as a journalist, have you spoken to any schemes or trustees or sponsors in the last few days about tariffs? Before we start on the main theme, let me put it that way. But Podreg, have you got a steer on what pension schemes and pension funds are saying, or?
Not schemes, but I've been speaking to lots of people ever since Trump first opened his mouth in his acceptance speech before the Democrats actually formally conceded. And we all know it's going to be an inflationary period. It's going to be tit for tat. Where it finally goes, who knows? Because if there's one thing you can be sure of, the man in charge in the White House isn't sure of what he's going to do next. So it's going to be wait and see.
Absolutely.
So it can't be any more definitive than that. But I mean, nobody knows what's going to happen anymore, possibly even less than we ever do.
Well, indeed. Rosalind, you got your hand up. Do you want to say something before we
I just
start for proper, as they say?
In case it's of interest to people, I do a lot of transactional work. I do a lot of work advising businesses that are buying or being bought, or trustees where an acquisition of the employer is going on. In the last in the last 3-4 days, I've had 2 transactions crater, one of which was about to happen. This is worse than I saw in March 2020. Just thought it would be interesting for people to know that.
Wow. Well, that's very interesting, Rosalind. Really thank you for your input on that. Were these so these were M&A deals, were they, that
Yeah.
basically just completely exploded? Wow.
Yeah,
Wow.
I mean, because people don't know how to price businesses anymore. Because if you look at the markets, people who trade in the price of businesses don't know what the price of businesses are. So people have lost the ability to price businesses. Now, I'm sure at some point they'll get them back, but in some ways, uncertainty, coming back to Padraig's point, is much worse for businesses than a collapse. Because a collapse, you know that everything's just halved in value. At the moment, people just don't know. If you look at the markets, they're bouncing all over the place.
Footsie's up 2% today, 2.13.
Yeah,
FTSE
exactly.
100.
In a
Yeah.
way, that's worse. I mean, if it was just, if we need to wait at a point where it settles, then everyone knows where they stand. And until that time, no one can value businesses. Because this isn't the markets having a financial crisis, which is what we've had in more recent economic crashes with markets. It's markets reacting to what they think will happen in the business world. So that's the thing that makes this different, if you like, from 2008, say, or the dot-com bubble or anything like that. Anyway, I thought it was interesting for people to know that.
Yeah, so that's real world stuff, Rosalind, isn't it? Actual deals falling over, which is a real
Yeah.
shame. Yeah. Sorry to interrupt, Julius. We've diverted slightly, but I thought tariffs were quite hot on the press, so I thought, well, I might as well ask you. So sorry about that.
Not at all. I'm sorry, I didn't have anything much more interesting to say. I thought Rosalind's comment was much more interesting than mine, frankly.
Yeah, no, I appreciate that. So getting back to the Evershed situation, we'll go through the list of questions that we've got on this. First of all, on the Evershed's fiduciary duty, what does it actually say, Julius? Do you want to comment on that first of all, and then we'll move on?
Well, in classic journalistic fashion, I'm going to answer a question you didn't ask me first,
Okay.
because I think it's really helpful context. So I did say I was going to unpack why we were interested in getting this opinion, and I think that is really helpful context for a number of the questions you're going to ask. So, as I mentioned earlier, we are supportive at NatWest Cushion of the government's growth agenda, and you may say, why? Is it because we're patriotic? Well, we may be, but that's not why. Actually, we have a very, very clear commercial interest in UK unquoted companies. So why do we? Well, because we're a fintech before we're a pension provider, and technology is at the heart of NatWest Cushion's proposition. And you do refer to this in one of the questions you're going to ask. This is the point about emotional connections. But we know from a bunch of empirical evidence that we can create emotional connections using our technology with members, which produce better member outcomes. We can unpack the logic of that later on as you ask me questions. But because we know we can do that, and we know that it's easier to create those emotional connections with assets that our members are going to encounter where they live and where they work, we want those assets. We need those assets to be in the UK because our members live and work in the UK. So that's why we are fundamentally interested in and excited by the idea of investing in UK properties, or UK assets, should I say, including properties, but UK companies. And so we approached Eversheds because in response to our consequent desire and enthusiasm for the Mansion House Compact, our trustees wanted some reassurance that were some of the UK investments in which they were undoubtedly going to be overweight prove not to deliver, they had some protection against future challenge. So that's the context. That's why we started talking to Eversheds about 6 to 8 months ago now. So what does the opinion actually say? Well, at the heart of it, it says something very simple. It says that trustees are required to take into account the impact of their investment decisions on their members' standards of living in retirement. It's essentially what the opinion says. And the opinion says they're required to do that because it opines that a member's standard of living in retirement is a financial factor, which needs to be consequently has to be taken into account by trustees as they are taking their investment decisions. So in summary, that's all it says. It's very simple. You must take into account the impact of your investment decisions on your members' standards of living in retirement. It doesn't tell you how you need to take that into account, how much weight you have to give it. It just says you have to take it into account. So given that it is at its heart very simple, and that's what it says, I think I'll pause my answer there.
Okay, interesting one. So obviously, you know, it's a fairly simple sort of viewpoint, but what doesn't it imply? I think that's. Oh, Con, you got your hand up. We'll come back to that in a minute, Julius. Con, you come in first, and then we'll ask the next question. Go on, Con.
Julius, I'm all in favour in principle of investing in my home markets. However, when I look at the UK, I see a very, very weak case indeed. If you look at the Labour share of national income, prior to Reeves, it had increased by some 8%. Now, increasing Labour share means lower share available for investment returns. Ordinarily, one might not have to worry about that, but productivity has not bailed it out. Productivity actually has, according to Resolution Foundation, been negative in recent years. So surely the prospects we see, which have been exacerbated by Reeves' episodes on national insurance and wage settlements and so on, surely the investment prospects for the UK are frankly fucking abysmal.
Well, the beauty of this opinion, Con, is that you are free to take that position. The opinion leaves you entirely free to take that position if you believe that position is correct, because the investment case that you've just advanced clearly would outweigh any improvement in our members' standards of living in retirement. And therefore, the opinion in no way constrains your investment freedom to reach the conclusion you've just reached. So really, that takes us to what it doesn't say. Well, it doesn't make you invest in the UK. That's absolutely clear. It doesn't make you privilege investment in a UK hospital over an investment in an Indonesian hospital if you believe the Indonesian hospital is going to give you a much higher return. However, what it does do is it forces you to pause and think about the extent to which your investment decisions may have a positive impact on your members in retirement. So where might that take you? So this is a counter argument, and I'm not saying your analysis is wrong, Con. I'm just saying that there is an alternative perspective, and one alternative perspective, which I think has got some intellectual credibility behind it, is to observe that if you want to invest in the UK, arguably the most interesting place to invest in the UK is via private markets. And the reason I say that is because I think it's possible to identify a material failure in the provision of capital as companies begin to scale in the UK. And the consequence of that has been one of two things, well, one of three things. Either the companies have failed, or the companies have had to bootstrap themselves for a year or so, maybe longer, and have delayed their growth surge, or the money's come from the US. And I think we've spoken to a large number of organizations in the market, both with a vested interest and without, who believe that the supply of pension fund capital can help realize some of those gains which have been going to American savers on behalf of UK savers. That's an alternative interpretation which our trustees believe is valid and means that they are enthusiastic alongside NatWest Cushion about investing in the UK. But if you believe the UK is fundamentally an unattractive place to invest, then you shouldn't be investing in it. And this opinion applies no pressure whatsoever to make you change your mind.
Okay. Well, we'll come back to this. I'd love to hear more about the opinion itself, which I obviously haven't seen.
Okay.
Well, there is in fact, Con, there's a summary that Eversheds have put into the public domain, which you can simply ask them for, or indeed I can probably make sure Steve and Henry got access to, and they can circulate it. And that's been put out there because there has been, I think, frankly, quite a lot of mischief making. I'm not quite sure from what kind of interested party, but I've seen some extraordinary claims. Two of the most wild claims would be that Eversheds were lent on to provide this opinion to a commercial partner, which is bonkers because they weren't a commercial supplier of NatWest Cushion before I started talking to them. And the second one, that this opinion forces trustees to privilege the environment over investment returns, which it demonstrably doesn't.
Okay. So far, I've said nothing. I haven't read the thing, so I can't.
Well, what's your next
although
question?
I have to say, I think that those two interpretations are complete and utter BS.
Well, yeah, indeed, they are.
Wow, there you go. Okay. So moving on, and then no doubt Con may have another question. But Henry, you got your hand up. You go next.
Yeah, my point is that Hyman's have produced a very good report this morning, 30-page report, and quite a large part of it is about their view about what pensions should be mandated to do by government in terms of the investment of money. I don't know what your view is of mandating from a government point of view and whether you feel that clashes.
Well, my personal view, Henry, is that having been a trustee, although not as of today, but a trustee for many decades, I mean, I hated being told what to do. And my position was always, the essence of fiduciary duty is me exercising my professional judgment. So don't tell me what to do, because there's no point in me being a fiduciary if you do tell me what to do. Having said that, perhaps unsurprisingly, the Treasury and the DWP, but particularly the Treasury and Torsten Bell, are very interested in this opinion. They dropped their arrangements, which ironically were to attend an Eversheds pension seminar to come and speak at our Mansion House launch of the opinion. And Eversheds complained bitterly that many of their attendees had cancelled the Eversheds session to come to ours. So it certainly created some interest. So there is a lot of interest on the part of the minister, but they continue to consult around the idea of compulsion. Torsten Bell is clear in his determination that he needs help to fix the UK productivity problem. So on that level, I think he'd agree with Con, and he thinks that DC schemes can help in part to fix that problem. Now, whether they should or not is a different question, but he thinks they can. And if this opinion doesn't help deliver on the Mansion House commitments, I think it's pretty clear we are going to see compulsion. But I'm optimistic that the opinion is significantly helpful in the sense that if you have any board of trustees that is more or less warm, sympathetic to the idea for whatever reason, and there can be lots of reasons for investing in the home market. It could be because you're switching out of listed equities overseas and you're replacing that with a UK unlisted allocation, which is boosting your expected return. It could be because you want to exploit this idea of emotional connections, which produce better member decisions, which produce better member outcomes, completely independent of the investment return. It could be because you actually think that you will have a big enough impact on your member standard of living if you act in concert with other DC schemes. If you built 100 hospitals across the UK in concert with other DC schemes, arguably you are having a material impact on your members' standards of living in retirement. So whatever your reason is for wanting to invest in the UK, this opinion gives you quite a lot of extra comfort around so doing. So I think it's pretty helpful. There are some trustee boards there, like Con, who just think, no, I don't want to invest in the UK. And if they are sufficiently large in number, I think we will see mandation.
Yes,
Wow.
well, some would argue that nobody knows what they're doing, which is why we elect governments to tell us what to do. And I think that's quite an interesting point of view, especially if your mindset is similar to that of the government that you actually have in charge of it. It's a very difficult view to accept if you are, for instance, of a different persuasion with regard to political views. So it becomes very, very difficult, doesn't it, when politics start getting mixed up with fiduciary duty.
Yeah, indeed.
Yeah.
Con, I'm gonna, if I may, I know you've not asked me a question. I can see Philip's got his hand up. So Philip, apologies, but I'm going to say two more things about the opinion, since Con, I think, is keen to hear a little bit more. There are two strands to the argument to underpin this opinion. One is weaker than the other strand. So the first strand says that if you believe there is a general economy level connection between your investment decisions and your members' standards of living, then you may take that into account in your investment decision making. In fact, you must consider it, and it's reasonable to take it into account. But it's not a strong argument. A much stronger argument is where you could evidence a direct connection between an investment decision that you take and an improvement in your members' standard of living. So what might the direct connection look like, as opposed to, for example, an investment in Tesco shares in the secondary market, which the government's equally keen that we do, by the way, but I'm not particularly interested in. In fact, I'm not remotely interested in. So the kind of direct connections that the opinion addresses are centered around things like healthcare and social care. So if, for example, we were to invest in a biotechnology company which produces a new treatment for diabetes, or a new treatment for dementia, or a new cure for cancer, there's arguably an absolutely clear direct link between that investment and our members' standard of living in retirement. If we're building social housing needed by nurses and teachers, if we are creating new green spaces. So why green spaces? Because what the opinion is quite clear about, you can't take into account your members' quality of life in retirement. So when we began talking to FHS, they said, no, green spaces, that's all about quality of life. And we said, well, we're not sure that's right, because if you look at the creation of nature reserves, there's now a well-evidenced increase in the value of properties surrounding that nature reserve, about 10% uplift to property prices. And arguably, higher value properties should, in the long term at least, lead to higher council tax revenues and better provision of local services. So again, everyone says, yeah, no, that's a good direct connection. So we then talked about defence. Is the direct connection between not having the Russians cutting our pipelines and cutting off our internet services? Well, arguably, possibly so. So the whole point about this opinion is it's not prescriptive. It allows trustees the freedom to conclude that, well, there's a direct impact on our members' standards of living, which we think is sufficiently significant to merit a UK overweight. I'll stop there.
Okay, fine. Appreciate that. Philip, you had your hand raised, then we'll come to Jim.
Yeah, okay. Julius, thank you. So there's going to be a little bit of preamble for this question, and the answer could be short or long. What I understand that's being said about this opinion is just like it's okay for trustees to do this. That's what I hear, but I'm not clear about where's the incentive coming from to do something down this line. And let me explain what I mean by that. And I might actually give you a little bit of a segue to an answer. So on the Guide consumer site, we regularly poll the users, and the users are those who are like, plus 50 majority. They are heading towards retirement, and we ask them basically just like, where do they most want to put their money in terms of providers and funds. And it was a loaded question, because it was asking the older generation, how green are they? Because that was one of the answers. And green came last on the list, behind factors like charges, returns, and brand. It was last on the list. So it's just like, whilst it was just like, yes, of course, wouldn't green be the right thing to do? For that population, absolutely not. They were driven by other things. But of course, if you were to ask a younger generation, it could well be the other way round. They might well put green at the top. So the decisions that you're making about, well, doing such things, investing in the UK, might actually depend on the age and demographic of that individual. So when you're talking about improving the standard of life of the member, well, if it was investment in some massive infrastructure that would take 30 years to realize, that might be true for somebody who's 20, but may not be true for somebody who's in their late 50s. Does that
Yep.
That makes sense?
So
Yeah.
I think there are two really important points in there to pull out, Philip. So your first one, that members' values differ across cohorts. Well, yeah, they do, but this has got nothing to do with values. This opinion says nothing at all about needing to take into account what values members may or may not have. In fact, it's very, very hard for trustees to take non-financial factors into account. The whole point about this opinion is it says that the member's standard of living in retirement is a financial factor. And therefore, what the opinion does is it shifts the focus away from the size of the fund at retirement to what standard of living that pension fund can buy in the society into which your members are going to retire. So that is comprised of two things. It's comprised of the size of the fund and the price of goods and services in the society into which members retire. And the extent, therefore, to which your investments can help reduce the price of goods and services or improve the quality of goods and services that members are likely to need to buy in retirement, then it's reasonable to take this into account. But you made a second point about, well, yes, but different cohorts will have different views about what kind of societal, or I'm sorry, I've used the word views, I shouldn't have done that. Trustees will look at their member cohorts and conclude that their members' standards of living will be differentially affected by different investments depending on which cohort they're in. Absolutely right. So trustees do need to take that into account. But I think my view is that trustees generally have to make quite a lot of compromises in a default fund, because there is only one default fund. And because there's only one default fund you can be defaulted into, therefore, trustees have got to reach decisions about the best interests of the majority of their members. And I think the same thing applies to investing in societal infrastructure. So if I were a trustee, I would want to balance my investments to deliver across different timeframes. And if all my societal infrastructure investments only delivered over 50 years, I think I would be quite nervous.
Okay. I mean, Julius, before we come on to Jim and Rosalind, do you think the concept of two defaults would be a good idea then? If you're a master trust, a default for up to 45-year-olds and a default 45 to plus. Do you think there's a massive, is it broken, the default fund system?
I mean, that's a huge question, Steve. I mean, given that most master trusts now offer more than one default because there are commercial pressures around the combination of price and investment strategy, master trusts are already having to move away from offering a single default, but you offer a single default to a cohort of member. I think it is difficult, isn't it? Because as soon as you start anticipating individual member circumstances by age group, then people start saying, well, what about other factors which are definitely relevant? What about the other assets which members have? I think the increase in governance burden of multiplying the complexity of your default arrangements when we're already going to have to build, I think very shortly, default strategies for decumulation is possibly too much to ask of trustees right now. But I don't dispute the logic of your question, Steve, implicit in or explicit in Phil's challenge. You know, different cohorts of members have different needs, and that's kind of been recognised by having different exposures to risk assets at different points in the member journey. So, kind of in principle, yes, but is it something that's at the front of my list of things to do right now? Probably not.
No, it's more complicated as well. Yeah, I get that. Jim, thanks for being so patient. You're next, and then we'll come to Rosalind.
Thanks, Steve. Thank you, Julius. So my question is sort of around, in the LGPS, we had an opinion on fiduciary duty way back in 2014 and looking at similar things. And the opinion that came back was very much around the financial factors have to come first, but then if you can get the same returns, then you could look at other considerations. Had been updated recently. I haven't quite got the full detail of the update that was done this year on that one. But do you think there's potential challenge around the differences between those opinions? That was Nigel Griffin that we got to do that one.
Yeah, well, the Griffin opinion has just been updated, and when
right.
I first looked at it, I thought, well, that's bloody unhelpful. But actually, Eversheds have explicitly acknowledged the opinion and talked about why it's not inconsistent with their opinion. I mean, frankly, it's definitely not helpful. But bear in mind, what the Eversheds opinion has been careful to do is to therefore point out that they're not talking about quality of life. They're not talking about non-financial factors. They're only talking about financial factors. But they're saying financial factors are not only the expected return on assets. Financial factors are also what the eventual fund you deliver is going to be able to buy your members in terms of standard of living in retirement. So it's just forcing you to remain in the world of financial factors, but making you look beyond the expected risk return of the assets in which you're investing. But they clearly remain the dominant contributor to outcomes. So I was asked by a journalist who will remain nameless. So does this mean you can choose a lower returning asset over a higher returning asset if the impact on a member's standard of living is big enough? So I said, well, that's just a really unhelpfully reductive question, isn't it? Because the bottom line is that if the loss of return is large, well, of course not, because it's inconceivable that the loss of a significant bit of investment return is going to be made up for by, building even 100 hospitals across the UK. So what if the loss of return is really, really small? I said, well, that's still really unhelpfully reductive, because trustees never find themselves in a position where they are certain one investment is going to give them, 5 basis points less return over the next 20 years than another investment. That's just not the world that trustees live in. Broadly speaking, if you have investments that offer a broadly similar rate of risk and return, this opinion gives you a very strong reason for making decisions to overweight the UK. That's really all the decision does. And if you think that the investment returns are wildly different, as Con does, the opinion really has nothing to say to you at all.
Okay, Jim, you happy with that? He's nodding, thumbs up. That's good. Thank you, Julius. That's excellent. Rosalind, you got your hand raised as well.
Yeah, I just had a question which actually fits rather well with your discussion of the question you were asked. I hope you're not going to think this one's reductive. I don't think it is. Which is that obviously, as you allude to, the impact of investing is really something that does depend on scale, and I do wonder the extent to which, whereas this is incredibly useful for a fund like Cushion that has an awful lot of people and frankly a lot of funds, and is in a place where it's going to invest, its invest may genuinely have an impact on the market. I think my what I understand of this is that the sort of standard of living argument makes more sense with a much bigger group, so that if you have small investments, because you are a small fund, this is going to be less helpful to you. You're going to be less able to make use of this, I'd say. And is that fair, do you think, or do you think it works even on a very small scale?
Well, first of all, it's definitely not a reductive question. It absolutely goes to the heart of the opinion, because you do have to be able to point to an impact on members' standards of living. So the Eversheds opinion is explicit around this point as well. It discusses it in detail. And what it says that you have to be confident that your investment decision will have a sufficiently significant impact, either on your own, either acting on your own or acting in concert with others.
Yeah.
So if you are a small scheme and you sign up to Mansion House, then I think the opinion is clear that you can draw some comfort, if you wish to, for UK overweight, based on the fact you are acting in concert with others. But it's quite clear the bigger you are, the stronger the support this opinion provides. And I would say that, you were very generous in saying Cushion's got lots of assets. We've only got 3 billion. We only had 300 billion when I started working for Cushion. So, tenfold increase already. But, the opinion is explicit again in saying that you either have to have assets which will meet the government's scale test, because if you don't, you won't be around. And therefore, your investments won't see their impacts being delivered. So you either have to have scale already that meets the government's anticipated scale test, or you have to have a convincing argument to show that you are going to get to the government's scale requirements. So actually, the opinion is quite tough. So while you have some narrow support, some weak support, if you're a small fund, if you're Cushion size, you have to be very confident. I'm sorry, let's rephrase that. Your trustees have to be very confident you are going to meet the government scale tests before they lean on this argument. So we've had to talk to our trustees about why the NatWest distribution promise is going to give us a high degree of likelihood that we will meet the government scale tests before they were willing to lean on this argument. So the bigger you are, the stronger support the argument provides you.
Thank you.
Okay, thanks, Rosalind. Henry, do you want to? You got your hand raised?
Yeah, I hope you can hear me.
Yep.
What Hymans are saying is that their proposals would make 285 billion available to the Treasury over 10 years. And they're suggesting that this money is invested in the wealth funds, the national wealth fund of the governments, and that the decisions on how that money is invested primarily down to the Treasury, with relatively little input from trustees. They just get on with handing the money over. What do you think of that?
Well, I think the opinion is not hugely helpful for trustees who are inclined to go down that route, because you are basically subcontracting any potential connection between your members' standard of living in retirement and investment decisions to a third party. So I don't think that's certainly not Cushion's trustees' preferred route. Cushion's trustees are having detailed conversations with potential providers of private equity and even venture at the moment about the sectors in which they're going to be investing, and the conversations where there is a clear link between the sectoral investment and members' standards of living in retirement are the conversations which are going forwards.
Yeah, I mean, my view is that everyone's trying to be competitive and outperform each other in the hope of getting to their 25 billion. Whereas, in fact, what most punters like is certainty and consistency and the sort of things which government is talking about in terms of scale, in terms of doing what the government wants done, and make a lot of sense to ordinary people. So I see here, two different views emerging. One which is the providers wanting to actually do it their own way and show that they are different, and people like the government saying, well, actually, we don't want you all to be different. We'd like you to all do the same sort of thing and invest collectively. And that to me is kind of like quite an important feature, really, of a debate at the moment, and one that's not properly getting expression because the providers are sort of dominating it to an extent when we have conversations like this. But if I go in and talk to the government or the minister or whatever, I hear something quite different.
Well, Henry, look, it's a fair challenge, so let me respond. I was talking about the opinion. So if you were to, I think the implicit question was, what does the opinion have to say about subcontracting these investment decisions to government? And the answer is, well, it's not a very helpful opinion if that's what you want to do. Having said that, I think there are plenty of other reasons for at least considering investing collectively. As you know, I have attempted on a number of occasions, often in the public domain, to try and get master trusts to cooperate. One cooperation with Nest that actually did produce some results, although we didn't co-invest in the end. But generally speaking, providers are pretty unimpressed by my attempts to get them to cooperate. Generally, I get, that's fantastic, referred up to management, absolutely not under any circumstances, would be one recent response I got from a provider who shall remain nameless. But, you know, we are, you know, playing Cushion's book here a little bit in response to your question, Henry. We are trying to support the British Business Bank. So the British Business Bank are attempting to produce a DC-friendly investment structure. And we have been working with them. This is in the public domain. Rachel Reeves announced it in one of her speeches some time ago. We've been working with them to help them understand what makes a DC-friendly proposition. We're talking to them about the kind of areas of investment that would be particularly attractive to us, the kind of sectoral allocations that would align with the opinion, the kind of broad sustainability overlay that our trustees like to see, all other things being equal. And I remain optimistic that we will be supporting the British Business Bank with an allocation in due course. So I see both arguments, in fairness.
Okay, great. Thanks for it, Julius. Peter, you got your hand raised, and then we'll come to Adrian.
Yes, can you hear me to start with?
Yep.
Yes.
Thank you. Yeah, as I'm sort of having to ditch in and out this morning, I put a point in the chat about, in fact, this is all very interesting, but in fact, trustees in terms of the investment decisions are far more concerned, I think, and I think John Hamilton made this point at your presentation at Mansion House, about Section 58 and the pensions regulator having the power to assess trustees' decisions as to whether they have caused a loss to the members and therefore for which they become criminally liable. And that is actually far more significant. And in fact, in that situation, the person that's appointed to assess that is the pensions regulator, a government appointed person who has the objectives of meeting the government's aims in terms of pension protection fund and this sort of thing, whatever they may be in the future. And the interpretation and the past experience of the pensions regulator, particularly during the LDI, is that they have probably contributed more to the loss of pensions funds at the cost in the first instance to the employer, but ultimately to the member than anybody else. So I do wonder if we're sort of dancing on the head of a pin a little bit here about this opinion.
Well, as I understand it, this is a section which applies to DB schemes, and this opinion is a DC specific opinion.
Right.
So I don't really think that there is any conflict between the two. I mean, I agree. I think the section is perverse and dangerous. Mm-hmm. But I've never been a DB trustee, and therefore I think that as far as DC schemes are concerned, not only does this section not apply, but the pensions regulator is now making very clear noises that they are aligning with the government's agenda and will be supporting an allocation to UK growth assets through their value for money framework. It will be interesting to see exactly how they do that. So I feel a following wind blowing, at least in this instance, from the pensions regulator. Whether that's right or not is a separate discussion.
Well, Peter, have we got your hand still up, or have you neglected to take it down?
I've just forgotten to take it down, so yeah.
Okay, well, I'll move on to Adrian, who's been sitting waiting, if that's the case. Adrian.
Yeah, it's just picking up on your comments about being overweight in the UK, Julius. I'm just wondering if you give us a sense of quantification of that. So how far are you prepared to push it? Is it 5%? Is it at the margins? What's your thinking?
Yeah, well, another. I think that's a really interesting question because actually, if you want to deliver against Mansion House, you don't really need this opinion because the UK is, if you assume China's uninvestable, which is not an unreasonable assumption, the UK is the second largest VC market in the world. So actually, you can probably get to Mansion House without leaning too heavily on this opinion. So how far might one go? Well, I mean, I'm now speaking my book, not Cushion's books. This is a personal opinion. But starting with a fact, Cushion has a 15% allocation to private market assets, half of which is allocated to private equity, and about, well, a slither of that is allocated to venture. So how far might we go, and what might that mean in terms of a UK allocation? Well, I can see a world in which the value for money framework allows us to push our illiquid allocations to 25, certainly 20, maybe even 25%. 20%, certainly I think that's 50% in private equity. Maybe it's still 50% in private equity by the time you get to 25%. And how much of that is in the UK? I don't know. I think maybe half of that might be in the UK. And then you've got some infrastructure alongside. I mean, I think you could end up with, which would appear to be a significant UK overweight. And I think the other point just to make, which is just a behavioural observation, DC trustees are used to investing in listed equities, which means they're used to market cap, MSCI global market cap benchmarks. And therefore, when they see a proposed allocation to UK private markets, they may not even be aware that they're actually as a market cap weighting. They may think, well, this is a bonkers weighting to UK assets because it's not 4%. And similarly, we've had behavioural challenges around getting our trustees to move away from a listed equity portfolio, which has got 1,700 stocks in it, to a private markets sleeve, a UK private market sleeve, which has got, well, my goodness, maybe 5. No, that's completely unacceptable. Well, 20? Well, no. Can you get it to 50, please? Could you even get it to 70? Where we have VC managers saying, well, 70 is the absolute maximum. You go beyond 70, there's absolutely no point in allocating. So there is some mismatch of expectations around this whole topic, not directly in response to your question, but I think interesting and certainly prompted by your question. But I think it could be, look, a lot depends on how successful the government is with their agenda. And if Con's right, and the government completely fails in its attempt to improve productivity and stimulate productive investment in the UK, then the figure is going to be a lot smaller.
Yeah.
Right. I think any further questions at this point? Because you've got a good 10 minutes left, Julius. Are there other points that you want to raise, or do you want me to come back to you?
Well, I think if nobody's got any other questions, I'd really like to unpick the other strand to this argument, because I think, again, particularly addressing Con, because for us at Cushion, the investment return is not the only driver of member outcomes. In fact, far from it. So we've talked in this opinion around how a member's standard of living interacts with the expected risk and return of the assets into which you invest. But there is this other dimension, which is profoundly significant for Cushion and has, we believe, and we think there's good empirical evidence, we're gathering it as we speak, to show that a UK asset produces a bigger pension fund for members than a non-UK asset, regardless of the investment return it delivers. So how does that train of thought run, and why is it a reasonable one? Well, there is a huge amount of empirical evidence to show that, coming back on your point, Phil, it depends what the asset is, right? It depends on the member and the asset. but there is a huge amount of empirical evidence to show that members respond on an emotional level to different types of investment. So for some members, it is investment in green infrastructure. For some members, it might be the restoration of some peatland near where they live. It might be some reforestation. It might be the introduction of golden eagles into a forest on the Scottish borders for the first time in 200 years. It might be a hospital built in their community. It might be social housing for nurses and for teachers built in their community. It might be a wind farm that they drive past on their way to work. It might be some regenerative agriculture. Who knows what it might be? It depends on the interests of the member. But we know that you can create these emotional connections, and our technology makes that very, very easy to do. Separately, we know that there's hugely extensive empirical evidence that demonstrates once you have an emotional connection established, members are far, far, far more willing to do the difficult stuff. This is what's called task persistence. If you've got a member that's emotionally invested in a relationship, then they will invest far more time doing stuff they would otherwise not be bothered to do. And in this context, what that means is taking time out to look at their contribution rates, look at what difference putting an extra £50 a month into their pension fund might make, looking to see whether, in fact, they might be better off in a different fund outside the default. If they're in the default, making sure that their expected retirement date aligns with the benefit vesting date of the default fund choice that they've made. And then finally, perhaps most complicated, but Phil will be interested in this, making sure that as they get closer to retirement, they've thought about how they might want to take their benefits to make sure there isn't a mismatch between the de-risking strategy they've chosen and the way they're going to take their benefits. Now, if you can get them to do those things, there is massive amounts of evidence that produces better member outcomes. So at Cushion, we believe there is a direct link between a UK-cited asset from which you can build an emotional connection with a member and better member outcomes in the form of a bigger pension fund for members to enjoy. That is another entirely separate reason why we think it's reasonable and why our trustees agree it's reasonable to be particularly interested in UK-cited assets, because that's where our members work and live. Those are the assets they're going to encounter more easily, more frequently, and with a more punchy emotional connection.
Chris. Thank you, Julius. Chris.
Thanks, Henry. Yeah, thanks, Julius. It's really interesting, and having been out with family and seeing them watch their solar panels create energy pennies at a time, which is apparently more interesting than my conversation when I was out with them. I can completely understand that emotional attachment and what it does to people. I think it's a really good point. Is the extension of that then, from what you're saying, is the extension that at Cushion you might offer default funds that have a particular focus on, for example, green issues or other sort of well-being type issues, so that members can tailor their preferences and get that emotional connection without having to choose the exact funds they do that with?
Well, I think we have an alternative solution, but it's essentially driving towards the same outcome. So we intend to use AI to understand our members' preferences. So members who live in Birmingham who are interested in technology will get push notifications via the app about the new, low carbon steel making process that they have just invested in Birmingham. Well, there probably aren't any steel makers in Birmingham, but sorry, that was a really bad example. Scunthorpe would be better, wouldn't it? But maybe steel making we should steer clear of. But whatever it is they're interested in, we will tailor the messaging. And it's clear now that you can learn a great deal about your customers via the interactions you have with them. And if you employ that intelligently, so you don't annoy them with endless prompts, a real balance to be found there. Amazon at its best when it does if you read this, Julius, then I think you might like this. It does a pretty good job most of the time. And that's kind of the objective we have at Cushion.
So it would be the same fund for everyone, but you just highlight the different bits that are
exactly that
most important to individuals.
Yeah.
Cool. Thank you.
Tom, back to you.
I think the illustration for Birmingham, Julius, would probably be a rubbish incinerator in your back garden at the moment.
Yeah, probably less popular as well as a consequence.
Yeah, I'm not sure what that would do for the atmosphere, but there you are. I suppose in the past Birmingham had a worse atmosphere than could be produced today. I'm having some difficulty with this idea of emotional attachment and standard of living.
Yeah, they are unconnected, Con. They are unconnected. You're right. They are unconnected. It's a parallel, completely unconnected argument, but it's another reason why Cushion is interested in UK overweight. That's all.
Okay.
It's nothing to do with member standard of living in retirement.
Okay. I'm glad, because I couldn't make the connection.
One of the things that we've been hearing quite a lot about recently has been Nest's position with regard to investment, not just the purchase of the Australian IMF, but also wanting to increasingly buy the kind of stocks which give regular income, so infrastructure stocks, whatever it might be, and so on. Are you beginning to think like them about building a portfolio of stocks to pay people pensions in later life?
Yes. So let me two comments about Nest. First of all, I was talking to Mark Fawcett a couple of weeks ago, and he was saying, can I just understand this opinion? Because I don't think it's relevant for our trustees, because they're already making huge place-based investments in the UK. So I said, well, yeah, no, it's not relevant for them at all. They don't need the confidence to make those decisions. But Catherine Howarth, who is one of Nest's trustees, has been hugely supportive of this whole process, because while Nest trustees may not feel the need for any comfort for being materially overweight UK place-based assets, other trustees do feel the need for comfort. So that was just an irrelevant Nest comment. So to answer your question, or a tangential Nest comment, to answer your question, yes, absolutely. And at the moment, we have a single private market sleeve, which, because it's delegated to Schroders, we have no control over the SAA thereof. And absolutely the forefront of our thinking already underway in terms of a search for new mandates is to break that LTAF apart and set up a series of different mandates. So VC, private equity, private debt, and infrastructure would be good examples to illustrate your point, Henry. So we will be materially overweight venture and private equity during the accumulation phase, and move to being overweight private debt and infrastructure in the decumulation and de-risking phase. Now, it's not quite where you would like us to get to. We're not paying a guaranteed income, although we are looking at longevity hedging solutions. I think that is very important. But
I'm not really interested in guaranteed income. I'm just interested in certain income.
Yeah. Well, I think the longevity hedge at least gives you certainty you won't run out of money by the time you retire. And I think that's where Cushion is at the moment. But to your specific question, yes, absolutely. We expect to be overweight income generating private market assets as we move from accumulation into decumulation.
Okay. And you're actually teamed up with Nest, aren't you, on some of your investments?
No. We had a brief cooperation with Nest over natural capital, but in the end, we wanted something slightly different from our mandate, which we have now made a selection. But it's not quite yet in the public domain, and Nest went a more conventional standing forestry route, which we didn't want to do, not least because we wanted those emotional connections, and we think there are better natural capital mandates than buying a bunch of pines in Scotland.
Okay. All right. Any further questions before we wrap this one up? Well, if that's the case, thank you very much indeed, Julius, for being with us this morning. I'm sorry I didn't get to hear what went on at the Mansion House, but I've had it recounted back to me. It's been nice. And I'm very pleased that Kushon are taking such a strong view on this, you know, because this is where we got to be. For those people who haven't seen it, I will recommend the Hyman's paper, which I read from my day in hospital yesterday, and which I think is absolutely excellent. And we hope to have them along very shortly. I'd like to ask everyone to say thank you very much indeed to Julius, and do that. Have you got anything you want to say to wrap up, Julius?
No, just thanks everybody for talking, listening, and for those great questions. Lots of really, really good questions. Thank you very much.
Right. Well, it's lovely to have you. Cheers, everybody, and see you next Tuesday.
Cheers.